Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is April 25th, 2024, and we're going to discuss bonds, banks, and builders make strange bedfellows. So primarily what we're trying to do is we're trying to do a follow-up to some of the things we've been talking about over the last couple of weeks. We've talked about the fact that home builders had reached a peak, created a lower high when we came into this level about 111 to 112. And that it looked like a good time to short bonds. In fact, we took positions in the main room and in the long-term portfolio here and here, benefiting from non-directional or bearish moves. So we already set up that trade to benefit us as it continues to move lower, and we still have potentially some lower lows. As you can see, today's gap down, test of the low, and recovery seems to be reflecting the anticipation of growth and recovery from a terrible GDP number, but I don't think that's all there is to it. We want to look deeper into what we're seeing in bonds, bond yields, and what the banks are doing. So a lot of times people will look at the market and say that bond yields are going to drive banks. So if bond yields go higher, that banks make more money. And I've been very emphatic about the fact that that is not the case. Banks make yield spread. They don't make money off their reserves. And if they did, they'd have to have significant reserves waiting in the wings in cash at a much lower borrowed rate. However, that's not the case. So let's look at a comparison between home builders, ITB, and you could use XHB here, and compare that to, say, KRE, regional banks, and bond yield. This is a comparison chart for the last year, comparing home builders, which are in the candlesticks, the blue line, which is interest rates, the 10-year Treasury yield, this red line, which is banks, regional banks, and then the purple line is actually bond prices. But bond prices aren't going to move as a percentage the same way. I put it on there just so you can see the movement, and it's going to go counter to this, but we really want to see these upper three to get a real perspective of how things move. And as you look at this, we can quickly see, pretty clearly see, that the yields are going opposite of what we're seeing in home builders and banks. Pretty direct, pretty straightforward. It looks like an ink blot test. They're going opposite direction, almost the same magnitude. When yields go up, home builders go down, banks go down. When yields come down, home builders go up, banks go up. Back and forth over the entire year. And we could go back even further and find these same correlations or inverse correlations between banks and home builders, and inverse correlation between the 10-year Treasury yield and the same. So as we're watching this, we're looking at the moves going up and down through here. We could bet on higher yields do not help banks, but lending at lower rates to get their yield spread, they make the same 2% yield spread whether rates are at 2% or 5%. And so banks make more money when builders are building. Banks make more money, regional banks specifically, when they are writing new loans and then packaging them and selling them. And that's why they rise with home builders and fall with home builders. As we're looking at this, though, you can see that we kind of decoupled right through here this year. So previously, walking in lockstep. Great correlation between home builders and regional banks. And opposite or inverse compared to Treasury yields. As we watch this, we see this decoupling, paying attention to the purple line and home builders, the candlesticks. Let's zoom in to this shorter time frame of just this year. Now you'll note that decoupling happened early in the year, but paying attention to the candlesticks and this red line, you can see that they started getting back in play after February. So we saw them rise together, fall together, rise together, lower highs, lower lows, lower lows, lower lows. This little bounce, banks did better over the last couple of weeks, rallied back up here and put in a top based off this close price right at the same time we put in a top in home builders. So if home builders clear their lows, that is probably a good indication that the banks are going to loan less. They're not going to be getting the same number of loans. They're not going to be able to do that. And we're going to see that likely because, as you can see, the 10-year Treasury yield is breaking out to the top side. Despite the rally in home builders, the yields are breaking up to the top side, which would infer again that the banks are going to lend less. So when yields rise, we're still keeping this correlated or inversely correlated to yields when we're talking to banks. Home builders, it's speculative, while banks seem to be responding mathematically to what we should expect with bond yields. So today's gap up, close down, or excuse me, gap down, close down is likely putting in a top here. Now, whether we can get through the low and continue lower, that's to be seen. But if we are, then we created lower highs, lower lows, lower highs, lower lows, lower highs. The next lower low should bring us down to about 44. And if we're going to 44, we're looking at about an 8 to 10% drop in regional banks. Regional banks then, from the high of just last December, going down to 44, will be off the top of nearly 20%. So banks just aren't doing well if they're not lending. Again, it doesn't matter where the interest rates are to some extent. It matters whether they can get loans written and whether they can do business and make their 2% yield spread. If we go into OZK, Bank of the Ozarks, you can see that we've broken out through these highs. This created a widening pattern, and we're already past earnings. Now, if we look at the earnings reports, you can see they came in at 151, 1 penny better than the last quarter. It's just a matter of whether they're going to be loaning further. Now, that doesn't mean that I want to go short here. Just like we talked about last week, I want to bet against the weak and in favor of the strong as we're looking for these charts to tell us who is doing the best. And as we look at OZK, we would look at their cash flow, their sales, and they're doing well. They're actually increasing. They're trending up month over month, year over year. So OZK, Bank of the Ozark, may not be the one that we want to short, but we may want to look at some things that are going to create a reversal pattern that don't have the same fundamentals or don't have the same strength in their numbers, that maybe don't have the free cash flow, maybe don't have the increasing sales per share. Now, MTB has seen a decrease in free cash flow, a decrease in dividend payout, a decrease in net profit margins. And so even though they just put in a new record high today, this could be one that we would look to sell short premium into, such as selling a call vertical above the highs. Normally, I don't like to do that on a 52-week breakout, but it's a breakout and failure with fundamentals that maybe are a little more questionable. Let's do 3 others really quick. And I think these all have a little bit of a different story, each one. We can go with TFC. Truist. They're a big mortgage company, and they buy a lot of mortgage papers, meaning consumer mortgages. You can see that their gap down, close down is probably more significant, confirming the peak, and they've already reported earnings as well. And as you can see, their earnings beat expectations. They rallied, and now we've reversed all the way back through that earnings. If the rates are going to continue to rise, there's probably going to be less mortgages to buy. There's going to be less mortgages to service, and we could see them falling back down to 35 as well. And that's going to be about another 10% drop in Truist. As we look at HBAN, you can see this is set up for a lower high, lower low. You can see their earnings have already passed as well. We're already past all these bank earnings. And so we're really playing now no hype. We're playing the idea of we've already reacted, responded to earnings. Now we're looking forward to the next quarter. So this looks to me to be a lower high. And if we fall back to the lows here, we're looking for a 10% correction on Huntington Bank. The last one I want to look at is kind of outside of what we would look at on all the others, and that is Zion, Z-I-O-N or Zion, depending on who you are and how you pronounce it. But Zion's Bank Corp is a bank that primarily buys commercial paper. This would be more representative of bank loans to businesses, small businesses, buildings primarily. And so when we're looking at buildings, they often buy SBA paper. So an SBA loan is created and Zion's buys it up. Bank of the West buys it, Zion's Bank buys it, even GE buys it, GE Capital buys them. But this is commercial paper. And as I look at Zion, we're not even close to the highs. We're doing the same gap down, close down. The move back down to this short-term low at 38 is another 10%. And again, we're already past earnings, so we don't need to worry about that. And Zion missed. So this is one that missed compared to everybody else. And there's been some bigger concern over commercial paper or commercial buildings, commercial real estate. If we have less demand because after the pandemic lockdown, we've seen more people work from home or remote work. If we've seen a slowdown in renting, and even if there's not, if there's a slowdown overall, like we saw with GDP today, if we're seeing it slow down and go sub 2%, that is an indication to businesses that maybe we want to slow down on spending. No new buildings, no expansion. And if we're looking at that, then Zion, who is a lender of commercial paper and a buyer of commercial paper, is probably going to see less as well. Now, their net profit margin has been getting worse for the last 3 years. We've already put in a peak way back here at 46. If we fall back down just to those lows from 46 to 40, now we're talking about a 15% correction just to these lows. And if we clear that low, I don't see anything stopping it from falling all the way down to 34. I don't have to bet against it by buying long puts or selling the stock, but I could get away with selling verticals or selling call verticals up here near 44. If they're not going to make the money and the yields are going to go higher, there's going to be less lending and therefore less yield spreads and less service contracts that they're going to get. Now, one that is not a regional bank but does a lot of consumer lending and they can make a bigger yield spread would be someone like Capital One Financial. And I think that's the reason why they're all the way up near these highs. But I do think you're going to see more defaults in the credit card line of business and in the automotive, which we already talked about in previous weeks with CarMax and Ally. Capital One Financial may have put in a top here and just falling back down to the lows at 136. We're talking about a 10-point correction, nearly a 7% move lower in Capital One Financial to retest the lows. And I'm looking for that to likely happen, especially after today's move and ahead of earnings. Now, this earnings report, as you can see, is going to report here very shortly. It's after market today. I think the market already was pricing in a miss and a pullback, and so I expect this to open up tomorrow probably down in the 143 at least, and the expected move on Capital One Financial is about 5 points. So we could go all the way back down to 139 or 140. And as far as going back to the mortgages and Zions and the commercial loans and individual loans and Capital One Financial, all of that's still going to be predicated on whether bond prices continue to sell off. If we continue to see lower highs, lower lows, lower highs, lower lows, if we fall back to the annual low near 89, as far as IEF, that's the 7 and 10-year Treasury bonds, we should be expecting to see yields go up to retest their annual high, which is near 5.5%. And therefore, we should expect to see mortgages go up to 7.5% to 8%, which will further destroy or limit demand on borrowing, and therefore the potential of cash flow and more earnings for the banks. Well, that's going to do it for me today. Thanks for watching. Join me again next week and join me tomorrow as we do TheoTRADE Live in the morning. Have a great day.